Hey, welcome back. I looked into StoneCo before and many of you were interested, so here is a more in-depth look into them. This is kind of the Brazilian equivalent of PayPal, or even closer Block, focusing mostly on merchants, digital banking and POS. As you can imagine, this kind of company is very tied to the economy and we can see very significant growth in pretty much everything. From 2020 to 2024, they pretty much quadrupled the revenue and also became profitable in not the best environment. This, by the way, is a stock that I actually bought recently, and if you want to support the channel and see whenever I buy anything, check out the Patreon link below. We see compound annual growth rates in the tens to even hundreds in pretty much everything, but the stock is near the all-time lows. They also talk about the huge potential to expand in the Brazilian market, and I have to add here the potential to expand in the whole continent. Combine it with rate cuts and a friendlier environment for businesses and you can see the potential. They seem to be in that stage where revenue growth is still okay, although it was affected by things I'll mention in a bit, but what's more impressive is the growth in profitability. We see the net income margin grow significantly year over year from 13.9 to 17.5%. They had some bumps in the road, but usually this is when companies become able to self-sustain, repay the debt or do dividends and buybacks. Now, even if it's a growth company and you generally value them based especially on the future potential, this company makes nearly 400 million USD in net income on a roughly 3 billion market cap, meaning a ratio of 7 to 8. The only difference, I guess, is that this is a Brazilian company, so the market accounts for more risk, and this isn't the only case, as you'll see later in the video. But at the same time, we are looking at low expectations that may not be justified, and any growth above that or positive news could potentially bring a very nice profit. As a parenthesis, I don't think Brazil is such a risky place to warrant this type of ratio, and there may be other reasons, including the market not being fully aware of this company yet. But there is still a risk, of course, but more on that in a bit. Financially, we see a good position with the current assets covering the total liabilities. What's left is about 2.68 billion in equity on a similar market cap, which is definitely not bad. They seem to have increased the debt quite a bit lately, but that's mostly due to them expanding the credit portfolio. And this is a reason why banks can be a bit tricky to analyze. But overall, not a bad position. They have a ton of cash on hand, the equity is growing and the business is developing. They had a bunch of problems, from lawsuits, a POS provider having issues with the US government, supply chain issues, some loophole in the Brazilian system that the merchants were able to take advantage of, and even a bad acquisition. Now, however, pretty much everything is in the past and they have a new CEO that back in 2023 expected a profit of around 750 million in 2027. To be fair, they seem to be on track to achieve it, and since he took office, things are indeed much better for the company. That would put them at a ratio of like 4, which is probably way too low for the market to ignore. They could then repay all the debt or do even 25% buybacks sustainably if they want to, so it would be very tough to see them not move if that happens. Now, I have to mention that the environment, as much potential as there is in Brazil, is very competitive. Don't think only about Pags or other local suppliers. You have to remember that this market could be a point of interest for any global or especially American company. Margins can fall, competition can heat up, it's ultimately very dynamic. It can also be an opportunity because they are relatively very tiny companies, and even someone like PayPal or SoFi on top of Amazon or Apple could be interested in an acquisition. You know, for PayPal for example, that's like a 7% increase in revenue for maybe not even 5% of the market cap if they want to issue stock. So it's something to consider by default, but you have to add the potential to grow on top. That 7% could become 10% in a year or 20% in half a decade, especially if PayPal uses its money and know-how to develop it. Plus, there is potential to develop in the region. Amazon and the others, for some reason, don't seem to focus that much on South America, despite the potential being very attractive. But of course, there is political and economic risk, and you can never know what can happen with Trump and bricks that can really deteriorate the environment. I say that he even threatened 100% tariffs on them, which would be really interesting. Brazil, for example, is a key country when it comes to vital commodities like iron. What happens especially to the US when you put 100% tariffs on that? Brazil accounts for like half of the iron ore imports that the US does, by the way, so it's not a small thing that you can just buy from another country. Not to mention that you probably put tariffs even on that other country. I get adding tariffs to bring back the local production and stuff, but commodities are very different and the economy depends a lot on them. I mean, if you look at the EU and the sanctions on Russia after the war, we didn't stop buying every commodity at once. Iron ore, LNG, oil were very delicate topics and they were done in stages. A quick look into PAGs for a reference, on a similar 2.5 billion market cap, they can make about 350 million in net income right now, so very good and a similar ratio to StoneCo. The overall business is very similar and I think even the valuations could be the same. Financially, we see another very good position with the current assets covering the total liabilities and basically zero debt. On a 2.5 billion market cap, there is about 2.5 billion in equity, so again quite attractive, especially for a digital company. I guess a key difference is that about 40% of this company is owned by the Folia group, which owns a bunch of media in Brazil. It's just a difference, not necessarily something negative. Sure, they could sell it and make it crash, but at the same time they could be willing to buy more or negotiate a deal with a buyer like Amazon and make a profit for everyone. But in general, I'd prefer something like StoneCo to avoid any surprises. Also, at the time of recording this at least, StoneCo does pretty much double PagS's buybacks, by the way. They doubled the program last year to around 350 million, meaning around a 10-12% yield for a 100% payout, but it's uncapped, not necessarily in a year. Now, about Warren Buffett buying and then selling this, I don't think it's very relevant. I think he only has control over the bigger transactions and it's possible that he has no idea that they even bought this. In general, I'm not really following what this type of investors do, and they are after all huge companies that aren't as free to buy whatever they want. And as a note, if they bought the whole company, it would cost them like 1% of their cash and equivalents. If it was his portfolio, sure, then it's a much better indicator, and if he bought, then it's very clear what he thinks about them, but this should always be at most an idea for us to look into, not something to blindly follow. This is the same for everyone, and to be fair, most people have at least one good idea worth looking into. Now let's see a valuation. In a bad scenario with competition ramping up, let's say they develop but the net income only reaches around 200 million on average due to a much lower margin. For a ratio of 6, which is very low for such a company and even below the current levels, that's a market cap of 1.2 billion. That's a price of 4.04, meaning a loss of 50-60%, although it can be better if they continue the buybacks. But at the same time, that's like half of the lowest point ever, and the price to book ratio would be like 0.5, so maybe someone could buy them and mitigate some of the loss. In a second scenario, let's say that due to the competition they remain at 400 million. With the buybacks and a slightly better market sentiment, let's say the ratio is at 12. That's a market cap of 4.8 billion, meaning a price of 16.19 for a pretty good 60-70% profit. Again, this is basically them stagnating or growing but with a lower margin, so not bad for such a scenario. Now, in a better scenario, let's say they manage to reach the CEO's target and get to 750 million. For a ratio of 15, that's a market cap of 11.25 billion, meaning a price of 37.88 for nearly a 4x. This can be much better if they ramp up the buybacks and could also be possible especially if they repay some debt. Plus, there is potential to develop internationally, so that 750 million could become maybe even more than a billion in the long term. So overall, quite an interesting company at a good price. Healthy, close to a price to book ratio of 1, can make very good money, and I think they enter into the next stage of development. If they reach their target, this could be an easy multi-bagger, especially if they keep up the buybacks and the market sentiment improves. Plus, they offer exposure to Brazil and emerging markets, and they have potential to develop a lot in the region. But it remains a very competitive environment, and even if that also means potential to be bought, there is this constant pressure in a very dynamic market. As always, what I cover in my videos shouldn't be enough for you to make make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.